Banks are pursuing partnerships with fintechs in order to pursue opportunity with ease. They face pressures on their revenue stream, they face pressures on seeking deposits, and fintechs offer that opportunity to readily deploy technology to bring new services and operating activities to their customers to be responsive to what the customer needs. And they can do so in a way that doesn't require rip and replace from the technology they have. They can do so with quick implementation and bring it to life just alongside what they're already doing. Financial institutions are expected to understand the risks they face in operating their business. My advice is they need to be thinking about this fintech firm as a partner, and is, in essence, how would you treat a business unit? If you were going to bring on a new business unit, stand up a new channel, what would you think about in terms of the risks? Fintechs right out of the gate, it's third-party risk management. And you know what? In the IT space, that's where third-party risk management as a risk discipline started. So we know this very well around interacting with technology firms, that there are a number of risks. How do they operate? How are they managing their information security? How are they managing your customer data privacy? How are they operating from a strategic risk perspective? What is the management team of that fintech firm? What does their expertise derive from? When you're choosing a fintech firm to be a part of your strategy, you need to be thinking about, again, the risks that it presents. How does it fit within your risk appetite? And how does it help you achieve your strategy? So that requires a set of metrics, it requires a set of performance measures, and what are your objectives? Have you clearly defined the objective that you want to accomplish, the problem that you're trying to solve with this technology? And when the board articulates that, strategic planning is really where it starts. And then the mandate then goes down to management. It says, this is what we want you to deliver. And management then executes on behalf of the board. So management, therefore, has a responsibility to evaluate and monitor how that fintech is performing, understand the emerging risks that might arise in the operations of that fintech firm that might catch you by surprise, and to have that ongoing relationship and acute understanding of the operating environment, the security environment, the efficacy of the controls at the fintech firm in order to understand, again, what the bank's aggregate risk profile looks like, and to be able to incorporate that fintech firm's contribution to that aggregate risk profile, and then to be able to make decisions on what do we want to do. Is this risk we want to accept? Is this risk we need to further mitigate? Is this a fintech partnership, God forbid, that you need to exit, right? That's what is so important on behalf of the board and management in supporting the board in fulfilling its duty. Bank leaders and management can effectively manage these risks through a number of different tools and approaches. I think the first and foremost is the importance of establishing a meaningful relationship with the management team of the fintech firm. You need to understand how they're operating their business. You need to understand what they're bringing to bear to you as a client, and you need to understand how they think about the risks that they face in delivery of that service. So have a conversation with their risk officer, talk to their compliance officer, talk to their technology officer, talk to their head of operations, even their head of strategy. Understanding where that fintech is going and what it's trying to do and how it manages itself is so important.